Let me tell you something about shorting stocks that most investors never understand. Shorting is not about being negative. Shorting is not about hoping companies fail. Shorting is about recognizing reality before everyone else does. It is about seeing what is broken, what is overvalued, what is destined to fall, and positioning yourself to profit when the truth finally comes out. I have been shorting stocks for over 50 years. I have made fortunes betting against companies that were frauds, companies that were overvalued, companies whose business models were destined to fail. And I have learned that the best shorts are not complicated. They are obvious. They are situations where the gap between perception and reality is so wide that eventually, inevitably, the stock price has to collapse. Today, I am going to share with you the 5 stocks I would short right now if I had to put money on the line. These are not theoretical positions. These are companies with fundamental problems that I believe will lead to massive declines in their stock prices. Companies where the risk-reward for shorting is overwhelmingly in your favor. But before I reveal these 5 stocks, I need to explain how I think about shorting, because most people get it completely wrong. They short stocks because they went up too fast. They short stocks because they read some negative article. They short stocks because they have a gut feeling. That is not how you make money shorting. That is how you lose your shirt. The first rule of shorting is that you can be right and still lose money. Let me say that again, because it is so important. You can be absolutely right about a company being overvalued, about its business model being broken, about its management being fraudulent, and you can still lose money if the stock keeps going up before it goes down. The market can stay irrational longer than you can stay solvent. I have seen shorts blow up because they were right, but early they had the analysis correct. The company was a fraud, but the stock doubled before it collapsed, and the short sellers got squeezed out before they could profit. So timing matters, catalysts matter. You need to identify not just what is wrong with a company, but why, and when the market is going to recognize what is wrong. Otherwise, you are just bleeding money while you wait for the inevitable. The second rule of shorting is that the best shorts have multiple things wrong with them. A company with one problem can survive, management can fix it, the market can ignore it, but a company with 5 problems, with a broken business model, terrible balance sheet, declining revenues, accounting shenanigans, and management selling stock, that company is going down, is just a matter of time. When I look for shorts, I look for what I call the perfect storm. Multiple factors all pointing in the same direction, all suggesting that the stock price is going to fall. When you find that combination, when everything lines up, those are the shorts that pay off big. The third rule of shorting is that you need to manage your risk obsessively. When you buy a stock, the most you can lose is 100%. But when you short a stock, your losses are theoretically unlimited. If you short a stock at $50 and it goes to $500, you lose 10 times your initial investment. That kind of loss can destroy you. So position sizing matters enormously. I never put more than a small percentage of my portfolio into any single short position. I use stop losses. I monitor positions constantly. I am willing to take a small loss to avoid a catastrophic loss. Shorting is not for the faint of heart or the undisciplined. With those principles in mind, let me tell you about the 5 stocks I would short right now. The first stock I would short is a company I will call the cloud software darling, you know, the type. A software as a service company that went public during the pandemic. Boom revenue growing 40 or 50% a year, gross margins of 75%, all the metrics that growth investors love. Except for one thing, the company has never made money. It burns hundreds of millions of dollars every year. It has been in business for over a decade and has never generated a single dollar of profit. The path to profitability that management keeps promising is always 2 or 3 years away, always just over the horizon. Never actually arriving during the pandemic when interest rates were 0 and growth was all that mattered. Investors did not care about profitability. They cared about revenue growth, they cared about market share, they cared about the total addressable market. And they bid these stocks up to absurd valuations, 20 times revenue, 30 times revenue, valuations that could only be justified if these companies eventually dominated their markets and generated enormous profits. But here is what has changed. Interest rates are no longer 0, they are 5%. And when the risk-free rate is 5%, investors start caring about profits. They start asking when, not if, these companies will make money. They start doing the math and realizing that even if everything goes perfectly, the stocks are still overvalued. The company I am talking about is trading at 15 times revenue, 15 times. That means if they generate $1 billion in revenue, the market is valuing them at $15 billion. But they lose $200 million a year. Their revenue growth has slowed from 50% to 20%. Competition is intensifying. The easy land grab phase is over. For this stock to be worth its current price, the company needs to maintain high growth rates for years, achieve profit margins that few software companies ever achieve, and fight off competition from larger, better funded rivals. What are the odds of all that happening in my estimation? Very low. Meanwhile, the downside is enormous. If growth slows further, if profit margins disappoint, if the market decides that 10 times revenue is a more appropriate valuation, the stock falls 30 or 40%. If things get really bad, if the company starts losing customers and burning through cash, the stock could fall 70 or 80%. That is the kind of risk reward I look for in a short, limited upside, enormous downside, multiple problems all pointing in the same direction. Let me tell you what makes this short even more attractive. The company has significant stock-based compensation. They pay their employees largely in stock, which means every quarter they are issuing millions of new shares. These shares dilute existing shareholders. They add to the share count. Even if the stock price stays flat, you are losing value as your percentage of the company shrinks. And when I look at the insider transactions, I see that executives are selling stock as fast as they can. Every quarter, the CEO sells, the CFO sells, the other executives sell, they file their Form 4s, and they sell. They talk about how bullish they are on conference calls, and then they sell. Actions speak louder than words. If management really believed the stock was undervalued, they would be buying, not selling. The fact that they are dumping shares as fast as their lockups allow tells me everything I need to know about what they really think. The final catalyst for this short is competition. The big technology companies are entering this space, companies with unlimited resources, companies that can afford to lose money for years to win market share, companies that can bundle this software with other products and give it away for free. How does a money-losing startup compete with that? They cannot cut prices because they are already losing money. They cannot outspend on marketing because they do not have the resources. They cannot innovate faster because the big companies have more engineers. They are trapped. This is the classic innovator's dilemma in reverse. The startup disrupted the old way of doing things. Now the big companies have caught up, and the startup has no moat, no sustainable competitive advantage, nothing to prevent the big companies from crushing them. The stock is going down, maybe not tomorrow, maybe not next quarter, but within the next couple of years, this stock will be 50% lower than it is today, maybe 70% lower. The fundamentals demand it. The second stock I would short is an office REIT, a real estate investment trust that owns office buildings in major cities. I have talked before about the problems in commercial real estate, but let me be specific about why office REITs are such attractive shorts. These companies own buildings that are worth far less than they were 5 years ago. Vacancy rates have exploded, rents have fallen, the work from home revolution has permanently reduced demand for office space. Everyone knows this. It is not a secret. But here is what many investors do not realize. The REITs have not marked down their assets to reflect reality. They are still carrying these buildings on their books at values that assume full occupancy and rising rents. The gap between the stated value and the real value is enormous. Eventually, that gap has to close. Either the REITs sell buildings and realize the losses, or they refinance their debt and lenders force them to write down the assets, or they just slowly bleed as rental income declines and they cannot cover their dividend payments. The dividend is the key to this short office. REITs have traditionally attracted investors because of their high dividend yields. But those dividends are not sustainable. The cash flow to pay them is declining every quarter. At some point, the dividends will be cut. And when that happens, the income investors who own these stocks will flee, and the stock price will collapse. I am looking at an office REIT right now that is paying a dividend yield of 8%. 8% sounds great, right? Free money. But the dividend payout ratio is over 100%. They are paying out more in dividends than they are earning in cash flow. They are borrowing to pay the dividend. That is not sustainable. When the dividend cut comes, and it will come, the stock will fall 30, 40, maybe 50%. The investors who bought for the yield will panic and sell. The new equilibrium price will be far below where the stock trades today. That is my second short, an office REIT with an unsustainable dividend assets that are worth less than stated, and a business model that is permanently impaired. The third stock I would short is a regional bank with heavy commercial real estate exposure. I have talked about the problems in regional banking before. The unrealized losses on their bond portfolios, the deposit flight risk, the coming wave of commercial real estate loan defaults. But some regional banks are worse than others. Some loaded up on commercial real estate loans when times were good. They made loans on office buildings and shopping centers and apartment complexes. They made loans at low interest rates based on high property values, and now those loans are starting to go bad. The bank I am looking at has commercial real estate loans equal to 300% of its tangible equity. 300%. That means if just 1/3 of those loans go bad, the bank's equity is wiped out. Shareholders get nothing, and loans are going bad. Not all at once, slowly. One by one, a borrower misses a payment here. A property goes into foreclosure there. The bank sets aside reserves. The reserves eat into profits. The stock price drifts lower. But the real carnage has not started yet. Most of the commercial real estate loans have not matured yet. The borrowers are still making payments on their old low-interest loans. But over the next 2 years, hundreds of millions of dollars in loans are going to mature. The borrowers are going to have to refinance at higher rates. Many of them are not going to be able to. They are going to default. When that wave of defaults hits, this bank is going to take massive losses. Losses that will wipe out several quarters of earnings, maybe several years of earnings. The stock is going to collapse right now. The stock trades at 70% of tangible book value. That seems cheap. But book value assumes those commercial real estate loans are worth par. They are not. They are worth 50 or 60 cents on the dollar, maybe less. If you adjust book value for realistic loan values, the stock is trading at a premium, not a discount. That is my third short, a regional bank sitting on a mountain of commercial real estate loans that are about to blow up. What makes this short particularly compelling is the timing. We are right at the beginning of the commercial real estate loan maturity wave. The really big maturities are in 2025 and 2026. That is when the pain is going to hit right. Now, the bank can pretend everything is fine. They can say the loans are performing. They can point to low delinquency rates. But that is because the old loans have not matured yet. The borrowers are still making payments on loans with 3% interest rates. When those loans mature, when the borrowers have to refinance at 7 or 8%, that is when the defaults start. That is when the losses hit. That is when the stock collapses. I have positioned my short to benefit from this timing. I am not fighting the current narrative. I am waiting for the narrative to change. And it will change when the losses start showing up in the quarterly results, when the reserves start building, when the dividend gets cut. That is when the stock falls. Not before. The market needs a catalyst to reprice the stock. The catalyst is coming. I just need to be patient. The fourth stock I would short is what I call the meme stock zombie. You know, the type, a company that should have gone bankrupt years ago, a company with a broken business model, declining revenues, massive losses, and a stock price that defies all logic. These companies survive because retail investors on social media keep buying the stock. They form communities around these stocks. They convince each other that the shorts are wrong, that a turnaround is coming, that the stock is going to squeeze to the moon. They create a cult around a dying company, and sometimes they succeed in the short term. They drive the stock price up, they squeeze the short sellers, they create massive volatility, but they cannot change the underlying reality. The company is still losing money. The business is still declining. Eventually, gravity wins. The company I am looking at has lost money for 10 consecutive years. Revenue has declined by 50% over the past 5 years. They have closed thousands of stores. They have laid off thousands of employees. They have tried every turnaround strategy imaginable. Nothing works. The only thing keeping the company alive is periodic stock offerings. They issue shares to raise cash. The cash buys them a few more quarters of survival. Then they run low on cash and issue more shares. Each offering dilutes existing shareholders. Each offering pushes the inevitable bankruptcy a little further into the future. But the end is coming. The company cannot keep issuing shares forever. At some point, the retail army will get tired of buying. At some point, the stock price will be too low to raise meaningful capital. At some point, the company will run out of options and file for bankruptcy. When that happens, the stock goes to zero. All those retail investors who thought they were sticking it to Wall Street will lose everything. And the short sellers who had the patience to wait will finally be rewarded. The timing on this short is tricky. Meme stocks can spike at any moment. You need to be prepared for volatility. You need to size your position small enough that you can survive a squeeze. But if you are patient, if you can hold through the volatility, the payoff is enormous. A stock going from $10 to zero is a 100% return for a short seller. That is my fourth short, a meme stock zombie being kept alive by retail enthusiasm, but destined for bankruptcy. Let me tell you something about meme stocks that the retail armies do not want to hear. The fundamentals always win in the end. Always you can create temporary distortions. You can squeeze short sellers. You can drive stocks to ridiculous prices for weeks or months. But you cannot change the underlying reality of a business. If a company is losing money, if customers are leaving, if the business model is broken, no amount of social media enthusiasm can fix that. The company will eventually fail. And when it fails, the shareholders get wiped out. I have seen this pattern play out dozens of times. Retail investors pile into a failing company. They convince each other it is going to turn around. They attack anyone who points out the problems. They create echo chambers where only bullish opinions are allowed. And then reality intrudes. The company reports another bad quarter. The turnaround plan fails again. The cash runs low. The stock slowly bleeds lower. The enthusiasts get discouraged and move on to the next meme, and the company eventually files for bankruptcy. The smart money, the short sellers, the institutional investors, they know this. They have seen it before. They can wait. They can be patient. They know that time is on their side when the fundamentals are broken. What makes this particular meme stock attractive as a short is the math of the balance sheet. They have maybe 18 months of cash left at current burn rates. That means they need to either turn profitable, which is not going to happen, or raise more capital. And every time they raise capital, they dilute shareholders. They issue shares at whatever price they can get. The share count goes up, the value per share goes down. I am betting that the retail enthusiasm eventually fades, that the stock offerings become more and more dilutive, that the path to bankruptcy becomes clearer and clearer, and when it does, the stock goes to zero. The fifth stock I would short is a company with accounting red flags, a company where the numbers do not add up, where the gap between reported earnings and cash flow is suspicious, where management keeps changing metrics and moving goalposts, where insiders are selling stock as fast as they can. I have seen this pattern many times over my career. Companies that look great on paper but are actually frauds. Companies where management is manipulating the numbers to keep the stock price up while they cash out. Companies that eventually collapse when the truth comes out. The company I am looking at has reported profits every quarter for the past 3 years. The stock has performed well. Analysts love it. Management gives great presentations. Everything looks perfect. But if you dig into the numbers, things do not add up. The company reports strong earnings, but cash flow from operations is negative. How can you have earnings without cash? The answer is usually aggressive accounting, revenue recognition that books sales before cash is collected, expenses that get capitalized instead of expensed, reserves that get released to boost earnings. I have also noticed that management keeps changing how they report results. They introduce new metrics that make the business look better. They stop reporting metrics that make the business look worse. They guide to one thing, miss it, and then explain why the new guidance is actually better. This is classic manipulation. And then there is the insider selling. The CEO has sold $50 million in stock over the past year. The CFO has sold $30 million. Other executives have sold tens of millions more. They all have excuses, diversification, tax planning, charitable giving. But when everyone is selling, when no one is buying, that tells you something. The people who know the company best do not want to own the stock. I cannot prove that this company is a fraud. I do not have smoking gun evidence, but I have seen enough red flags over my career to know what they look like. And this company has red flags everywhere. When these situations blow up, they blow up fast. One day the company reports earnings and everything looks fine. The next day an investigative journalist publishes an article, or the auditors resign, or the SEC announces an investigation. The stock drops 50% before you can blink. Then it drops another 50%. That is my fifth short. A company with accounting red flags, insider selling, and a gap between reported results and reality. Let me explain why accounting frauds are such great shorts when you can identify them. The returns are asymmetric. If you are wrong and the company is legitimate, maybe the stock goes up 20 or 30%. You take a loss and move on. But if you are right and the fraud is exposed, the stock goes down 80 or 90%, maybe to zero. The potential gain is far larger than the potential loss. The key is identifying the frauds before they are exposed. And the red flags are usually there if you know where to look. Earnings that consistently beat estimates while cash flow disappoints. Revenue growth that does not match customer growth. Related party transactions that transfer value to insiders. Complex corporate structures that obscure where the money is really going. The company I am looking at has all of these red flags. Their earnings look great, but their free cash flow is negative. They book revenue from long-term contracts up front. Even though the cash will not come for years, they have transactions with entities controlled by executives that seem designed to inflate results. I cannot prove it is fraud. I am not making that accusation, but I have seen enough suspicious situations over my career to recognize the pattern. And the pattern here is troubling. When these situations unravel, they unravel fast. One day everything looks fine. The next day the auditor resigns, or the SEC sends a subpoena, or an investigative journalist publishes an expose. The stock gaps down 50% overnight. Then it keeps falling as more details emerge. The risk for short sellers is that the fraud continues for longer than expected. These companies can keep the game going for years sometimes. That is why position sizing is so important. You need to be able to hold the position through the waiting period without it destroying your portfolio. But when the collapse comes, it is spectacular. And the shorts who had the courage to bet against the fraud are richly rewarded. And let me talk about how I would structure these short positions, because the structure matters as much as the idea. Get it wrong and you can be right about the short but still lose money. First, position sizing. I would never put more than 2 or 3% of my portfolio into any single short position. Shorting is risky. Stocks can go up before they go down. Squeezes happen. You need to be able to survive being wrong in the short term to be right in the long term. Second, diversification. I have given you 5 shorts. Owning all 5 reduces your risk compared to owning just one. If one short goes against you, the others might work. Diversification applies to shorting, just like it applies to going long. Third, stop losses. I set stop losses on every short position. If a stock goes up 20 or 30% against me, I get out. I take the loss, I preserve capital, I can always re-enter the short later if the thesis still makes sense. What I cannot do is let a small loss become a catastrophic loss. Fourth, monitoring. I watch my short positions more carefully than my long positions. Things can change fast. A takeover offer can come out of nowhere. A short squeeze can develop. Management can announce something that changes the thesis. You need to be ready to act. Fifth, patience. Most shorts take time to play out. The market can ignore problems for quarters, even years. You need to be patient. You need to have conviction in your thesis. You need to be willing to wait for the catalyst that finally makes everyone else see what you see. Let me also talk about the psychology of shorting. It is different from going long. When you are long, time is on your side. Companies tend to grow over time. The economy tends to expand. Even if you buy a mediocre company, you might make money eventually. When you are short, time works against you. You are paying interest to borrow the shares. The company might issue positive news that temporarily boosts the stock. Other short sellers might give up, creating buying pressure. You are fighting an uphill battle. This means you need to be more selective about your shorts than your longs. You need higher conviction. You need clearer catalysts. You need better risk management. Shorting is not for everyone. Most investors should not do it. But for those who have the skill, the discipline, and the temperament, shorting can be enormously profitable. I want to share a few war stories from my decades of shorting, because theory is one thing, but experience is another. In the 1980s, I shorted a company that everyone loved, a high-flying conglomerate that was making acquisition after acquisition. The stock kept going up. Analysts were bullish. The CEO was on the cover of business magazines. But I looked at the balance sheet and saw a disaster waiting to happen. The company had taken on enormous debt to fund the acquisitions. The acquisitions were not generating enough cash to service the debt. The accounting was aggressive, booking profits from acquisitions that masked declining cash flow. I shorted the stock and it went against me for almost a year. The company kept doing deals. The stock kept rising. People thought I was crazy, but I held on because I knew the math did not work. Eventually, credit markets tightened. The company could not refinance its debt. The stock collapsed 90% in a matter of months. I made a fortune. In the 2000s, I shorted a company in the mortgage business. This was before the financial crisis. The company was making loans to people who could not afford them. They were booking profits immediately on loans that would default later. The stock was flying high. I looked at the loan quality and knew it was terrible. I looked at the accounting and knew it was aggressive. I shorted the stock and waited. It took 2 years, but eventually the defaults started piling up. The profits turned to losses. The stock collapsed. The company eventually went bankrupt. Another fortune made. The pattern is always the same. Find a company with fundamental problems. Find a company where the stock price does not reflect reality. Short it. Wait for the catalyst. Profit when reality finally asserts itself. The 5 stocks I have described today all fit this pattern. They all have fundamental problems. They are all overvalued relative to their actual worth. They all have catalysts coming that will force the market to recognize reality. The cloud software company cannot keep growing without profits forever. The music will stop. The office REIT cannot keep paying a dividend from a declining asset base. The cut will come. The regional bank cannot survive a wave of commercial real estate defaults. The losses will overwhelm them. The meme stock zombie cannot issue shares forever. Bankruptcy awaits. The company with accounting red flags cannot hide the truth indefinitely. The exposure will come. These are not hopes or wishes. These are logical conclusions based on fundamental analysis. The stocks will fall. The only question is when. Let me close with a warning. Shorting is not for amateurs. It requires skill, discipline, and emotional control that most investors do not have. If you do not know what you are doing, you will lose money, probably a lot of money. But for those who take the time to learn, who develop the skills, who can maintain discipline under pressure, shorting is a powerful tool. It allows you to profit in down markets. It allows you to hedge your long positions. It allows you to capitalize on overvaluation and fraud. The 5 shorts I have outlined today represent what I believe are some of the best risk-adjusted opportunities in the market. Companies where the downside is enormous and the upside is limited. Companies where multiple problems are all pointing in the same direction. Companies where the gap between perception and reality is wide and getting wider. If I had to put money on the line today, these are the stocks I would short, not because I want these companies to fail, but because I recognize that they are going to fail, and I want to be positioned to profit when they do. That is the essence of shorting. Not hoping for bad things to happen, recognizing that bad things are going to happen and positioning accordingly. The companies I have described have problems that cannot be solved. They are going down. The only question is whether you will profit from their decline or be a victim of it. Choose wisely. Manage your risk. Be patient. And when these stocks collapse, remember that you were warned.